Welcome to Retirement Unpacked, a weekly podcast by Parallel Wealth. I'm Adam Bornn, and each week, along with our team of experienced financial planners, we'll explore the ins and outs of retirement, from income strategies to taxes, lifestyle choices, and everything in between. Before we dive in, a quick note. What we share here is for educational purposes only. It's not personal financial advice. Everyone's situation is unique, so be sure to talk to a qualified financial planner before making decisions about your retirement. Let's get started. Welcome to episode 12 of Retirement Unpacked. My name is Adam Bornn. We have Brett Martinson, who is our manager of our financial planning team here at Parallel Wealth, and we're here to answer your retirement questions. And like always, if you have questions, comments, anything like that, make sure to leave it below, whether you're watching on YouTube or listening on Apple Podcasts, Spotify, or any other platform. So Brett, let's jump into it here with question number one.
Absolutely. So this one is clawback worth making more money? This is from David Noble, 8928. So I'll start with, I'll read it here. How to say you haven't seen Les Miserables without saying you haven't seen Les Miserables. I've seen Les Miserables. I think it's referring to a previous podcast of ours. If you get the reference, or if you know what they're referencing to, Adam, speak up.
Yeah, I think it was a previous one. It may have been mentioned, but yeah.
Anyways, well, we'll continue. I've seen so much content that really takes an almost allergic view of making more income than the point where clawback starts to happen. Old age security clawback, pension recovery tax. Isn't it a good problem to be getting old age security clawback? Can you show an example of where getting clawback is worse? Thanks very much. An admirer of Jean Valjean. Shoot, now I'm screwing up the name of that character. Okay, so Brett needs to focus on the important parts here. So
Brett's
in
sick,
terms
so Brett's not in 100% game mode here. Brett's fighting a cold, so we just got to fight.
We're going to blame the whole podcast on that.
Yeah,
okay.
Exactly.
Yeah. So in terms of that, yes, pension recovery tax is usually a good problem to have because it usually means that your net income before adjustments, which let's just call it taxable income for easy chatting, is $90,000 or more, give or take. So it is a good problem to have. The goal, I think, is to try to reduce it where possible without costing yourself more money or tax to do so than it would otherwise. So A, it is a good problem to have. Yes. B, doesn't mean that we can't necessarily try to reduce it or eliminate it. But when I see, in general, when I see a pension recovery tax kind of long and protracted, let's talk 10, 15 years, almost always, and again, there's always edge cases, almost always I'm costing the client more to try to get rid of that problem than to just have it being the lesser of the two evils. So I think all your comments are bang on. It's just about reducing it or eliminating if possible.
Yeah. And most people we find that are running into OAS clawback, they know they're going to run into it. And they're like, yeah, it's a good problem. Like if we can avoid it, obviously we'll try and avoid it. But we've also run plans for clients where it's like, no, do everything you can to get me my old age security. And it's like, hey, we've got your old age security for you, but you have a bigger tax bill. So it's like, yeah, you're getting this money, quote unquote, free money from the government, but you're paying that and more back because we've had to do bad tax planning to get the old age security. So yeah, like Brett said, it's a great problem. Avoid it, reduce it as much as you can, as long as it makes sense. So again, this is, if you run into old age security clawback, run it with your planner. Look at different options. Can you maybe not eliminate it, but reduce it? It's always a good thing. So.
Yeah. And a quick point on that, because we do hear from clients where like they'll talk about other advisors or whoever they talk, oh, it's not a good idea to do this. It's a good idea to delay, don't delay, whatever the case may be. And my point there is have them do the math. Plain and simple. Like, great, thank you for your opinion, but as financial planners, our opinion is not as important as our analysis. So have them do the math and show that, oh yes, A is better than B in this case, or B is better than A. So I wanted to get that out there.
Yeah. And that's where the comparison tool in Snap Projections, which is the software we use, it's great because we can build one option where you have OAS clawback, one where you maybe don't or have less, and then compare how much income, how much taxes, what's your state worth? Like which is actually better. Like there's a direct comparison between the two. So it's good for that.
Exactly.
So, question number 2. Can contributing to an RSP become counterproductive? And we hear this a lot. So this comes from at 1549413. Thanks for using your name. Hi there. From what I understand, after I retire, I can delay receiving payments from my defined benefit pension plan until I turn 71. So we've talked about that previously. Just be aware you may be able to delay, but is there a benefit to delay? Won't jump into that here. But if I did that and lived off my RRSP and maybe CPP in the meantime, could that be part of the overall or a smart approach overall? Also, separate question. Is there a point where contributing to an RSP becomes counterproductive? So again, on that first part, just make sure that there's an actual benefit to delay your defined benefit plan. If there is, then yeah, look at which is going to be better for you. Contributing to an RSP counterproductive. I'm already maxed out my TFSA and only get the new TFSA and RSP room each year, obviously. And he says he's 61, he or she 61 years old. So an RSP, we've talked about this a little bit before, almost always making an RSP contribution, especially in those later years of earnings where you're in your highest income years, likely, you're in a 30, 40, maybe 50% marginal tax rate. Contributing to an RSP will almost always make sense. Don't assume, well, because I've maxed out or because I have a big defined benefit pension plan or maxed your RSP already, probably makes sense. Again, I always, Brett always says it depends. I always say, go to your financial planner, like run the numbers. But I will say majority of the time we bump up against this and put in the numbers for the client, it's going to make sense to continue to contribute to your RRSP.
Yes. And the only caveat I would have to that is, and again, it comes down to the math, is if the RSP starts to not make sense in 2 areas. And I think we've touched on this before. One, am I projected to put that money in at a higher tax bracket than I plan to take it out at? And if the answer is yes, then okay, RSP is looking good. Number 2, am I going to be able to get all this RSP RRIF money out in a certain period of time? So which basically goes back to number 1, is if I've got so much of my RSP and RRIF, good problem to have, that I am now going to be taking out at a higher tax bracket than I put it in at. So you can have too much in there, but again, run the numbers with your planner, your financial advisor, because for every reason you're mentioning there, it may be much better to put it in the RSP contribution at these later years, potentially higher income earning years, than when you were 26 and incredibly low, potentially low income earning years.
Exactly. And there is such thing as you might like. I'm working on a plan for a client of ours right now, $23 million in his RRSP.
Oof.
Great problem to have. Great problem. Yep. But your every dollar you take out is at the highest tax rate. So
you've been keeping that one you've been keeping that one a secret from us. 23. Wow.
I know. It's yeah, exactly. There you go.
Yeah. Okay, number 3 here, melting down in retirement strategies with large RRSPs. I guess we're on a theme now. W. Woodcock's great video again. I've been watching Parallel Wealth videos since you began. These videos have been a wealth of information. I see what you did there. Good job. So in terms of he retired at 59. Wife retired 33 years later, living exclusively off of RSP RRIF withdrawals until closer to age 70. For both of us, we've maxed out the RSP contributions. I'm now melting down the RSP and staying within a tax bracket that allows us to live a literal rich lifestyle. Again, good problem to have. The RSP is now larger than I retired. The only thing stopping us from melting down is more tax. It just isn't melting. Again, good problem to have. Other than changing investment risk rewards, what other options are there? So again, this goes back to
whoa. You got to read the whole thing.
Oh,
Brett
goodness.
reminds me of red green.
Yep.
Forgot about that part.
Yeah, sorry. And I've got a prop for this. So let me answer the question here properly for those. I hope W. Woodcock is watching on YouTube here. I've got my flannel shirt on now. Yeah, there we go. Alrighty.
Amazing.
Yeah. Okay. So thanks for that. I totally missed that. So what options are there? So this goes back to the idea of, it may be painful to take more out of your RSP and RRIF now, but what does the math say of not taking more out now and possibly either A, being forced to take more out down the road, or passing away, either and leaving the spouse who now has no income splitting in that situation, or the second spouse passing away and there's a large tax bill at the end. So that's would be my suggestions for you. Is yes, RSPs are like a drug. They feel good when you put the money in, you get the tax break back. They don't feel good when you're taking the money out. But the opposite is true, is that they don't feel good when you're taking the money out and getting taxed, unless you see a plan that shows you, well, the lesser of two evils is to take more out now versus X down the road.
Yeah. And we see this, especially the last, I'll say 10 years or so. Like we've had 5 years, especially, we've had such a good market, right? Everyone's done well in their investments. So, if you're only pulling out 4, 5, 6%, I mean, you're not keeping up with probably the 7 to 10 growth rate that you have in your portfolio. So, I mean, that could change over time too. But you probably just have to start pulling more, because if your account now is higher than it was when you retired, you're not even pulling out the growth. You have a compounding issue, and you probably have parents or people that watching or listening have parents in their 80s, and it's like, they have hundreds of thousands in their RRIF account still. What happened? Well, you didn't pull enough out, right? This is the whole idea of the RRSP meltdown. So, again, make sure you have a clear plan that actually does decumulate. It's not just giving you the money you need. There's a tax piece behind it as well. So, question number 4, pros and cons of all-in-one ETFs. And Brett, by the way, thank you for putting the flannel on. I'm sure you will make that person very happy. So,
I hope so. Let me know when I need to take it off.
Yeah, there you go. Doug, you can keep it all day. That's fine with me, as long as your wife doesn't mind. Doug Linehan, 1824. I'll be retiring March next year. I have my portion of my DC, defined contribution pension, invested in a 3-year GIC, which is coming due next month. I was getting 5%, now looking at GICs. So many people had these 5% GICs. Now they're looking at different options. So I'm looking at investing in all-in-one ETFs, which are becoming very popular. I won't need to touch the money for 5 to 6 years. What is your opinion on these ETFs? I feel that because it's so diversified, it should be safe. So Brett and I aren't licensed to talk about investments, so we're not going to on this podcast. It's more retirement focused. I will say this, like, whether it's good or not, that's up to you. You can do your homework. But I will say in 5 or 6 years, when you need to start drawing down money, the all-in-one ETFs or any pooled product like that, I always say if you need $30,000 out of your RRIF, and it's in a pooled product, and you're just selling, say, units of that or shares of that, it becomes, well, you're selling a bit of everything. And so I personally am not a huge fan of the all-in-one in retirement. And again, that's our focus, right? The decumulation, building that cash wedge. But, I don't want to sell certain things. Like if the market's down, I don't want to sell equities. Well, in an all-in-one product, whether it's an all-in-one ETF, mutual fund, call it whatever you want, you're selling a bit of everything. So that would be my one concern. So maybe for the 5 or 6 years, you have kind of runway. Yeah, it could be one of the solutions you're looking at, but just be aware as you enter retirement, I'm not sure if they're a great solution. I think there probably will be something that comes to market over the next, let's call it 2 to 5 years that meets this retirement drawdown need. I don't think an all-in-one is maybe it.
Yeah. And they finished off the comment, which I feel that because it's so diversified, it should be a safe investment. There are no safe investments. There's guaranteed investments and there's non-guaranteed investments. So I think really this comes down to, I was getting 5% a year, so I was happy to have the money there, but now I'm probably not going to get 5% a year. GICs go up and down, just like the market does, just in different ways, in that they're guaranteed, but they do go up and down. And when it makes sense to make use of them, fantastic. And when it makes sense not to, then so on. So yeah, I would agree with the all-in-one ETF comment that you just made there. And you just did a video series on that in terms of, hey, if your money is in these types of investments, then here's how to do an RRSP meltdown. So maybe we'll put the link for that in the comments below. Yeah.
And the only safe investment out there is buying a flannel shirt to wear on your podcast.
There you go.
The only safe investment.
You know what? Let's do this upright. Yeah. By the way, Red Green, a bit of trivia here for you. Red Green started down the road from me at CHCH in Hamilton. So there you go.
There you go.
You are
And
now...
for those of you that are listening and not actually watching this podcast, just imagine like the tree skirt you put around your Christmas tree. That's basically what Brett has on right now. So there you go.
Oh gosh, I would never put this under a Christmas tree. This is,
Never
this is
get
my
branches
this is my
on that.
Neil Young, lumberjack look. Okay,
There
so next one here from Jill. Oh goodness, English is my first
Helsdingen.
language, and I'm terrible at it. Sorry, say that again.
Jill Helsdingen.
Helsdingen, thank you.
Jill's been a long time viewer, commenter, supporter of us. So yeah,
perfect. Sorry, Jill. Hi, Adam. Great video. Can you perhaps go into more detail how to have that conversation with parents? Realizing a beneficiary is important. What are some of the key points to mention, and how are transfers usually handled? Lump sum or gifting a bit each year. Thanks, Brett, for your input as well. Jill, one of the team members, Maddie, sent this to me actually in a personal message and say, "Hey, you're starting to get some notice here." So thanks,
and
Jill.
they're getting your name right.
Yeah, exactly.
It's not Brad, it's Brett.
Yeah. Towards the end of the comment, but nonetheless, I'm getting in there. So in terms of how to have that conversation with parents, lump sum and gifting a bit each year. So I'm going to start with the lump sum gifting a bit each year. It really comes down to your personal preference there. I think if you are going to do a lump sum gift, so basically we're taking more money and gifting it earlier rather than taking that same amount of money and gifting it over time, assuming that there's no major tax implications and stuff like that, to do so, that you just want to be comfortable and confident that if I hand this money over and I can't get it back because they've used it to pay down a mortgage or something like that, that I will still have enough money to get me through the rest of my plan. So that would be the consideration there. Gifting a little bit each year. I guess the other consideration would be how much is it going to help the next generation? So if the next generation is at a point that they've paid off their mortgage, for example, and now maybe this is just, hey, you're just helping them take the kids or the grandkids on another trip or something like that. Fantastic. Whereas if it would help them to pay down the mortgage and redirect that money to retirement savings or something like that, then maybe a lump sum is better to consider.
Yeah.
Your thoughts,
and I think
Adam?
the conversation with parents, I think there's a few pieces here. One could be, hey, mom and or dad or both. You have a lot of money in your RRIF and you're 81 years old. And at the rate you're pulling it out, you have a large check going to CRA. We need to figure out how to avoid that. I think anyone at any age wants to pay less tax. Now, again, I get that a lot of families don't talk about money. And I think that's transitioning, but definitely that generation that is 80 plus right now, they don't talk about money. So, but if you talk about, hey, you're going to pay a lot of taxes, that may open up that conversation. So there's that kind of bucket of people that have a lot of registered assets later in life that need to be dealt with. And, even mid 80s, like we do a lot of plans for clients or parents of clients that are in their 80s. And it's like, you know what? It's better late than never at the end of the day. So there's that problem. There's the other problem of, a lot of older people have a lot of non-registered assets. And it's actually, it's climbing back their old age security. It's creating a lot of tax bills. So it's like, this is an asset base that they're never going to spend. It's climb back their old age security. It's creating a big tax bill, whereas we can shuffle that money off to maybe the next generation or even skip a generation, get it to the grandkids. And now we're paying down debt. So we're getting rid of the tax bill and we're paying down debt. There's kind of this double benefit here. And that money is going to flow anyway. So like you talked about earlier, there's always that concern of, but if I pass this, am I going to be okay? So again, a good financial plan can map that out conservatively for clients. We've done it many times. But I think, what are the pain points of your parents? If your parents don't like to talk about money, they probably also don't like to pay taxes. So maybe like approach it in a way like that, where it's soft, but it also, it hits home with them of like, oh, okay, yeah, no. I'd rather give my money to my kids or grandkids or charity or whoever versus passing it off to CRA.
Yeah. And last comment I'd make about that is you broach it with them and maybe they don't want to talk about it at all. I think you just have to respect that decision. We have a lot of clients that have mentioned that to us, that, hey, I know this is possibly coming down the line with my parents and I know they should possibly be doing something about it. I've talked to them a couple times. I had a number of conversations with my father, accountant, okay, smart individual, knows taxes, but he just wasn't ready to start to take money out of an RSP or a RRIF, and it is what it is. So I'm not going to wreck my relationship with my father to keep pushing that point. And
Yeah,
a number of
exactly.
years later, he started to do it
They always come around
on his own accord. So it had nothing to do with my suggestions. Obviously, he came upon the idea completely on his own, I'm sure.
You probably watch one of my videos, so there you go. You're welcome. Question number 6, withdrawing from TFSA to put into non-reg an attribution. Yeah. So it's from at 99gman991. Great podcast, guys. Thank you. My question is, can you see any issue with my wife withdrawing $200,000 out of her TFSA and invest it in her non-reg? And then I gift her $200,000 to replenish her TFSA account in the new year. First off, it seems like there's an extra step here. As far as, do you need to pull the money out and well, no, she could just leave her money in her TFSA. You could, gift her $200,000. Now, again, there could be attribution here. You have to be really careful. Is that $200,000 yours? Is it hers? Is it joint? Is it be very, very careful. You probably have to do a spousal loan in a situation like this. I'd tread with caution here.
And I would certainly be, sorry, go ahead, Adam.
No, go.
I'd certainly be talking to an accountant as well. Absolutely. It's like doctors. There's many people on the medical team. There's many people on your financial team. Some people are going to know more about one thing than another. So yes, I'd be checking with an accountant who is knowledgeable in this area. Not all accountants do all the same things. And because for the reasons that you mentioned, is CRA going to see that money tax-wise as yours, hers, spread between both of you? It doesn't matter joint or not joint. It doesn't matter legal ownership. It matters tax. You're also, whenever we're moving money into registered accounts, and a TFSA is a registered account, so RRSP, TFSA, from a non-registered account, you want to be aware of the superficial loss rule. I won't go into details about that. Just do a quick search, find it on Government Canada page, but you want to stay on the right side of that rule. So tread carefully is certainly the word of the day here. Speak with a accountant, and I'm not saying there's not a benefit to what you're doing here, but yeah, I agree that it does sound like a bunch of steps. Because the first thing I'd be asking is as you said, can you do a spousal loan and just tackle this? Can you already income split this money if CRA determines that it's both your money? So I would start from there before adding extra steps.
Yeah, and when Brett and I both read this, it was kind of like red flags go off. Like there's a lot going on in this. Just be aware. So we'll move on.
Yeah. How does CPP work with dropout rates? This is from Kim Sakura 8494. Thank you for the information. Curious about how CPP is calculated because I have some zero income years and I'm planning to stop working or work very little before I collect CPP. Would you perhaps consider explaining the dropout 17% rate of lowest income earners in the equation? So first and foremost, we've mentioned it before, go to the PWL calculator. You can put in your income your income, your pensionable earnings in any given year, and it will calculate the dropout rates not only for low income earning years, but also child rearing provisions if you have that, disability provisions if you have that. So that would be the best place to go to kind of look at what the effects would be. The 17% dropout rate is, the rule there is that every Canadian gets a percentage, 17% of their contribution years. Adam, you might have to help me on this one because my mind is going on this. But 17% of the contribution years. So depending on not 17% from 18 to 65, but 17% on your contribution year. So if I only contribute for 5 years, let's say, and no child rearing provision, nothing. So it'll just be really extreme here. If I contribute for 5 years, then 17% of 5, I have very little to almost no dropout years. Whereas if I contribute for those full 42-ish, 40 whatever years, then I have almost 8 low income dropout years.
Yeah.
Did I miss anything there,
so,
Adam?
and that's why taking it at 60, you have less dropout years than delaying it till 65 as well, because you have less years, obviously, to work with. I will say this, the PWL calculator is really unique, too, in that when you put in all your information, it'll actually highlight what years it's dropping out.
Yes.
So it'll help you, like, as far as like why is it grabbing certain years, or what years is it grabbing? It actually shows you which years it's grabbing. So super helpful there as well. So make sure to check that out. Next question is around RRIF. So how to reduce taxes on RRIF upon death. This comes from Deborah Gardner, 1774. How can I reduce the taxes I pay from my RRIF, retirement income fund, upon death? Should I withdraw extra amounts from my RRIF in the year before my death? I have 2 adult children, no spouse, that are beneficiaries for my RRIF. I have $156,000 in my RRIF right now and have been given a terminal diagnosis. So Deborah, first off, so sorry to hear that. That obviously puts a bit of a wrench in the planning. If it's terminal illness and you have a shorter time frame, if it's I might not make it through 2026, then I would say take 2025, 2026, pull more than you need of that 156, spread it out. Ideally over a couple of years, maybe plan for 3 years. Like hopefully I get to 2027. Have that conversation with your doctor to figure out what is my life expectancy. But it's probably worth it pulling out more now, because even if we take your 156, divide that by 2, we're about 80 grand a year. We're still in that 30-ish% tax bracket, versus if it's all left for later, we're bumping into the 45 to 50% tax bracket. So it would make sense to pull a little bit now if you have that terminal diagnosis. Just to kind of smooth out as best you can, for sure. And it also, if you can get it out now, get it off to your kids, it does create a bit of a better estate play at the end of the day as well. Just a bit of a cleaner, easier way to pass to the kids.
Yeah. And again, also very sorry to hear about the diagnosis. And I was going to say the same thing in terms of, now it also depends on what other taxable income, Deborah, you may or may not have. But if when passing away, it's almost as if we just withdrew all that money from the RRSP or RRIF. So if we withdraw $150,000 today, then that's going to add $150,000 to your taxable income. If we withdraw $75,000 today being, it happens to be November, but this year, I should say, this calendar year, $75,000 this calendar year, and then $75,000 on January 5th of next calendar year, doesn't, it can be the first day in January, essentially, then you're going to add $75,000 to your taxable income this year, and you're going to add $75,000 to your taxable income next year. So it might make sense to attempt to pull that money out in some sort of manner, depending on the diagnosis and the length of time that you've been given. Can't really give you an exact number as we don't have all the information right here, but yes, it would make sense to absolutely be looking at that.
Yeah. Absolutely.
Next one's financial plan deliverables. And thank you very much, Deborah, for sending that in. Financial plan deliverables, what to expect, red flags for financial planning. This is from Neil Button 2334. Been watching for a while, listening to the podcast. Thanks for your help. What does it look like after a plan is delivered? I know I want one. So after all the discovery, the building, the delivery, and the updates, what does the client have? Does the plan include a schedule? Is it for when to take drawdowns? Is it percentage based? Is there a spreadsheet? A bunch of questions here. I'm going to start with kind of like the last question, which is what should I expect from my plan after I get the plan from my financial planner? I'm going to start with kind of, I guess, a general, and then we'll talk about how we do it, if that helps. Are there any red flags to watch out in the final phase? So first of all, I would say, hopefully you're not finding red flags in the final phase. If you're going to find any red flags, it's going to be early on. So what do I mean by that? Have a good conversation with the financial planner that you are considering working with, and talk a little bit about your situation, what you have, and things like that. Because what I would say you're going to be listening for is, are they listening like they are going to consider kind of pros and cons and different ways of doing things? Are they just giving you what I call absolutes, which is, oh, you should be starting your CPP right now, or you should be delaying your CPP? Either one, it's not right or wrong. It's just, if they have a specific mindset, that's actually against our principles as certified financial planning professionals, because one of the rules is to help Canadians make informed decisions without bringing our bias in. Now, we are human. Every human has a bias, but we are actually supposed to be working with ourselves to remove our bias. So I would be looking for that in the discussions that you have with your financial planner, to see, are they talking in kind of an open A and B, we'll look at this and we'll look at that, or are they just saying you should do this, should do this, should do this? Then you're probably not going to get some comparisons there. In terms of parallel wealth, because I can only speak to parallel wealth, every software is different, every planning is different. There's many roads to Rome type of thing. In terms of once everything is done, what does the client have? So from our side, you have a PDF of the plan. You also have an Excel spreadsheet of the plan. You have a video walkthrough of the plan. This doesn't even include the steps that we've gone through before up till then. So we have deliverables along the way, but that's the final deliverables. Yes, there is a spreadsheet, but it is a static spreadsheet that you change a number in a cell. That's the only cell that changes. There's not calculations behind that's going on. And that's just, any financial planning software I've used, I've never seen one that outputs a spreadsheet that allows for that. I could be wrong, but I still haven't seen one. How do you execute from it? You're either taking that responsibility on yourself, you are using your financial team, your investment advisor, accountant, or the financial planner will be implementing it, and you'll agree to that as part of the letter of engagement at the beginning. I think in annual update meetings, we have a couple. If you go to our website, and I'm sorry to make this a sales pitch, but if you go to our website, you'll see a couple different options in terms of clients can come back for updates, or they can work with our investment partners. So there's a few different things there, but every financial planner, every company is going to be different.
Yeah, we do
Adam?
it like the updates. Yeah, so a few things. So part of the deliverables is actually what Brett talked about, but we have a retirement guide, which kind of walks you like, how do you actually convert an RRSP to a RRIF and that kind of stuff. It's like a 32-page document just helping you. There's a terms and glossary section, right? Like you walk in your bank and they're saying all these words, like, what do these mean? So we've created that, like just stuff to help walk you and have success with it. We've also put together 11 implementation videos. So how do you actually implement your plan? I've done 11 videos walking you through like the key steps to implementation. But I think the biggest thing is a lot of the, I'll say, larger financial institutions, banks, etc. They've moved to a planning software that's very AI driven. And a lot of the bigger financial institutions, like you fit in one of 4 or 5 boxes. So it's like, that's what you get. The big feedback we get from people that come to us that have maybe had a plan elsewhere is, I got all these charts. And while charts look good, I don't understand them. And charts, when you're accumulating, you see it go up, feels good, looks good, I'm happy, it's going up.
Yeah.
But in the decumulation retirement phase of life, you need the data. And so one of the, both the PDF and Excel that you get from our team, and this is what you should ask for in any plan, like, where am I pulling my money from? How is this actually working? Like a step-by-step guide. And I always tell clients, like, if you take the Excel or the PDF, you can grab any year from now to age 95 and see exactly how much income, where it's coming from, how much tax, your average tax rate. Like, it's really easy step-by-step to follow. And I think that's the big part. I always say, I know our team can build a phenomenal plan for any of our clients, but if our clients can't understand it or know what to do next, it's useless. And so that deliverable, and we actually have the deliverables right on our website. So if you go to parallelwealth.com/planning, you can actually see there's sample deliverables. We have a full page. A lot of it's grayed out. You can imagine a lot of people ripped off of our deliverables. So we want to protect the integrity of it, but you can get a picture of like what I'm actually going to get through that process. So I would also say, you mentioned earlier too, when talking to a financial planner, like, not only what am I going to get, but do you actually provide retirement planning, right? I would say most financial planners are focused on accumulation, right? Asset accumulation, managing money, that kind of stuff. Very few focus on or actually know how to do the decumulation side of things. So that should be a question as well. But yeah, I think the main deliverable you should be walking away with is a step-by-step guide from now to whatever age you're looking to, plan out to. We do 95 typically, but you should be able to grab any year and know exactly how much money from what account, how much tax. Like the details should be simple. So that should be the number one thing you're looking for in all of that.
Yeah. Great question. Fantastic.
Yeah. Very good question. Yeah. And again, if you have follow-up questions, leave them below and we'll get that answer, because that is one of the things. Like a lot of people come to us, it's like, yeah, I've hired 2 people, you're going to be the third. Like, are you going to give us the same thing that the last 2 gave? It's like, no, it's different, right? It's here's what you're going to get. And that's why we put the samples right on our website. Like most people sign up for our services just right through our website, because everything's there. The price is there, what you're going to get there, the deliverables, the time, everything's there. So very transparent. So next question, high income, how to melt down RRIF to minimize taxes. So this comes from Chris4833. Great video. I have a question. If one has a taxable income of $300,000 before tax, any RRIF withdrawal, how does that one withdrawal melt down a large RRIF to minimize taxes on withdrawal? At the end of the day, if you're making $300,000, you're you're the top 1%, obviously. If you're retired making 300 grand, if that 300 grand is going to keep coming in for many years, it might just be you're withdrawing it at a 50% tax rate. Maybe you leave it for death. Like you got to start, you're that 1%. So you got to figure out what the best solution is for you. It's going to be very unique person to person. Like I said, I'm working on a plan right now, $23 million RRIF, many other assets. It's not a traditional plan, and that's okay, right? That's where plans need to be kind of built from the ground up. So you'd want to, if the 300 grand's only for a few more years and it's going to scale off, again, you got to work this through with your financial planner. 2 options. Let's say your 300,000 is for the rest of your life. Like we've had clients that they have like, mineral royalties or whatever it is. It's like, yeah, I'm getting this $250,000 for the rest of my life. It's growing with inflation. It's always going to be there. And I have $1 million RRIF. Well, look at drawing down the RRIF over time, delaying CPP, maybe all of that, or just taking out the minimum for the rest of your life out of your RRIF and paying a tax bill on death. Like what is better for you? Just run it, do it a pure apples to apples comparison, and that's going to give you your answer. So, but someone like this, pay for a professional, get a professional on your side. Hopefully if you're making that much money, you have some professionals on your side, or else you're probably paying a lot more tax than you should be. But that would be my feedback there.
Yeah, and I'm just going to touch on a comment that was made below that, Schulbetch 22. The melting down of an RRSP RRIF probably won't really matter. This is where I get into these absolutes. We have to be careful that it absolutely won't matter. It may not matter. It absolutely may not matter. Maybe a lot of that taxable income is because of a non-registered account where there's a lot of dividends going on, or interest income and things like that, which we may be able to change the characteristics of that tax, and it may not make anything better or worse or indifferent, but and I also come at it from a point of view of just being a bit of an optimist. Let's look at if there is a way that we can do something about this. And that comment may be absolutely correct. It's not going to matter, but it just depends on the characteristics of where that $300,000 is coming from and how long, as you said, Adam.
Yeah. So here's the situation. Let's say they have a large RRIF and they never need that RRIF money. Like if you're making 300 grand for the rest of your life, let's assume that RRIF probably isn't for you. Like it's being left to your kids or grandkids or something like that. So let's assume you have kids that still have mortgages, paying down debt, that kind of stuff. And at the end of the day, that RRIF is taxed at 50%. Whether you pull it out over time, at death, it's a 50% tax rate. Well, maybe you look at pulling 100% of it out now and passing it to your kids. Like they're going to get that money if they have debts and other kind of stuff. Like that could be one of the options. Now it's growing tax deferred in the RRIF, so that's beneficial. So it wouldn't make sense to pull it all out now and put it in non-reg and pay tax, and like that's not going to make sense. But if the money's for the kids or grandkids and you want to help them out now, it might be worth biting the bullet and just paying the 50% and passing it on and help create a bit more of that generational wealth. So again, there's many ways to go about this, but running through software but yeah, like what is the goal of the RRIF? If you're making 300 grand a year, you probably don't need it. Is it for kids, grandkids, charities, whatever it is? There's maybe some alternative options you can look at.
Yeah, absolutely. Next question, successor holder forms ignored by banks. This is from Richard Heitington. I've sent successor holder beneficiary forms through RBC 4 times and still hasn't changed. What can I do to get this fixed? Not
just RBC, by the way, all the
exactly. I was going to say the exact same thing and it to me it partly comes down to the advisor. There's great advisors at one institution. There's crappy advisors at the exact same institution. So it can come down to the advisor. It can come down to the company itself. So first and foremost, I would say if you're working with an advisor, they should be following up on this. When I was at Sun Life, we'd be calling into back office within a certain period of time that we felt like things should be done. If we didn't see it on our system yet, and say, has this been done? Are you waiting for anything from us? That type of thing. If you're not working with an advisor and you're do-it-yourself type of thing, then again, you're calling, in this case, RBC and saying, what do you need from me? Are you waiting for anything on me? But 4 times, that seems to be pretty extreme. So either something's getting lost in communication and they're not receiving everything that they should be, but they should be contacting you and saying, hey, we're missing this. Like, it's obvious you want to do something. Changing to another financial institution, I'm sorry to say it, but there's an option too. Just know with successor holder on TFSA, for example, there is an option in the Income Tax Act that, God forbid you pass away and you don't have a successor holder named on your TFSA, but you do have a spouse common law partner. It just is, it's more convenient, I'll just put it that way, to have a successor holder. It's more paperwork later if you don't have a successor holder, but you can get to the same end result. But it's not perfect. Beneficiary forms, that's a little bit of different. Like, you could probably talk to a lawyer and note somewhere, this is the beneficiary of my RSP, this is the beneficiary of my TFSA. But again, that's not going to be anywhere near as perfect as making sure the bank or financial institution updates it. I'd be getting on the phone and I would, again, not to slag on our RBC here, I would be looking at potentially another financial institution that's actually going to get it done. Yeah,
and that's
Adam?
My feedback. Like, if RBC is not working for you, there's many other options. Let me tell you, the local credit unions, the online options, they're really biting into this market. So if you're not getting the service you expect, time to move on maybe. So final question for today in this part of the segment is, can both spouses contribute to a spousal RSP and receive a tax break? And this comes from Anne-Marie Mosher 29. Absolutely. You can both. Now, the question everyone's going to ask is, well, why would you both do a spousal RSP? Like, why not just contribute to your own RSP? Typically, when we have clients that have spousal RSPs, like both would have it. I'll take my wife and I, when we got married years ago, my wife was a nurse making good money. I was starting this business, essentially not making a whole lot of money. And so she would have been she was the breadwinner. She was paying the bills. She could have made a contribution to my spousal RSP for me. So it would have been my spousal RSP. Fast forward to today, where I'm the breadwinner in the house. I could make a contribution to a spousal RSP for her. So come retirement, we might both have spousal RSPs. Would you want to make contributions to a spousal RSP like both at the same time? No, that wouldn't make sense. You might as well just contribute to your own RSP. But yeah, we definitely have clients come in and that each have spousal because there's been a shift in household income over time and the tax planning has changed, and that's good. We like to see that, like, you've adapted with the change of income within your household.
Yeah, and if the question here is, can both spouses contribute to the same spousal RSP, the answer is yes. I'll shout out to Alexandra McQueen, one of the top financial planners. She works with Financial Planning Canada now. Helped me understand that the Income Tax Act actually doesn't mention spousal RSP. It's an RSP that there's been a contribution from the spouse and a contribution from you, the annuitant. So you can absolutely make contributions to the same RSP. One of those is your contribution, the other one is the spousal. It does get, I think, a little bit confusing in terms of taking the money out and following the rules of what money was whose and when did it come in and go out. So that's the reason why I would potentially suggest having two different, and this is what, for example, I've got an individual RSP and a spousal RSP. My wife has an individual RSP and a spousal RSP. Yeah, I'd rather have 2 accounts and not 4, but it just is going to make it simpler when we go to start drawing money from there.
For sure.
So the answer is yes.
Steph set up Steph contributed to the spousal for me, say, earlier. And now if I wouldn't put money into that spousal RSP, I would set up my own RSP. Simplicity, that's the way everyone should do it. But yeah, no, good question. Next, what we saw this week, going to bring in Matt Dennis from our office. Matt's one of our partners here at the firm, financial planner, and he's going to share some insight with us. So Matthew, thanks for joining us. Maybe tell us a little bit about what we should learn this week.
Yeah, of course. Thanks, Adam, for having me on. So the key takeaway, something that we've learned this week, is that plans aren't built around investments. They're built around client goals. I think often that can be forgotten and it needs to be reminded, especially when you're working with couples. The reason I say that is you can go living a long time with one individual, but you're never going to line up on every single decision, especially around finances. And same thing goes for my wife and I too, right? With this situation, or a couple clients that I had a couple weeks ago, it was around having very different goals for their retirement. What to do with the wealth that they had amassed over the last 50 years of their working life, or the last 40 years. And for one, it was, let's spend as much as we can, as fast as we can, and enjoy retirement the way that we hoped to when we were in our 20s. And the other was, let's slow it down. Let's just save as much, tuck away as much as we can for a rainy day, or for just future wealth passing to kids, grandkids, whatever the case is.
And we hear this a lot, like where there's a difference. Like, what one spouse is, I want to be over here, one over here. And we've, definitely don't recommend this, but we've actually seen clients divorce at retirement. They're like, they want to go here, I want to go here. Like, we're just better enjoying retirement alone. Now, obviously, part of what you're talking about today is there can be this figuring out where it comes together. But a lot of our listeners, if you're struggling with this, it is normal.
Absolutely, yeah. And no, it's totally up to kind of the individuals too. You need almost something in front of you to work through this discussion, right? It's one thing just to have that discussion of, we are at crossroads here, we're differing opinions on what to do in retirement. That's where planning can be so beneficial, right? You can see in front of you the differences, the guardrails, how exactly will this work, to kind of bring in both of their opinions, both of their situations into one plan that lines up for the clients. At the end of the day, we want you to be happy, right? We want you guys to be the ones that feel confident with what is being taken away. So ultimately, what you can see through financial planning and for their situation is the guardrails that ensure that the one who does want to spend a bit more has confidence doing it. Like, it gives them a guardrail in a sense. Don't spend too much, because there is limitations. But it gives the one who's a bit more conservative on the spending side just that security and predictability of, okay, it is okay to spend more. You aren't going to be running into, debts or reliance on your kids in the future because of this.
Yeah.
And I think that's the biggest thing is, walk away feeling confident, especially in a planning situation where you've got guardrails. It's not always going to be the same for every individual. You're going to all have different goals and hopes for retirement, but planning does open up that conversation. I feel like I say this to clients all the time. We're 50% planners, 50% relational therapists, I feel like. And it's great to get to know clients, to understand their situation, actually show them what's possible, and understand that they're going to have differing opinions through the process itself.
And in this client situation, I know, because we were working on it together, there's, it was more we built the plan around the conservative, the person that kind of was running the finances in the house for decades. And so the plan was built around them, again, like enjoying retirement, but more conservative, helping the kids, that kind of stuff. The spouse wanted to spend more and travel more and spend more money. So it was, let's build this plan. And it's typically the more conservative person that has to stretch a little bit. But you can find that happy median where, okay, let's stretch up here. Like let's travel a bit more, or fly first class, or whatever you want to do. But you still have this buffer. You can still help out the kids. You can still do a lot of the things that the conservative person wanted to do. So again, if you're struggling with this, sit down with your financial planner and map it out, because there's this happy median. Again, we've heard many times where clients, have split at retirement. There's a better way to that, but definitely if you're running into this, it's not abnormal, and there's ways to plan through it and just look at, conservative and more aggressive side. And is there kind of this middle point where it makes sense for both of you financially? So yeah, Matt, thanks for sharing this, and we'll have you back on the podcast really soon. So thank you.
Thanks.
And tip of the week. So what I wanted to talk about for tip of the week was year-end account opening. So a lot of you are looking to retire next year, wanting to draw out a RRIF or LIFT, or start drawing down your retirement accounts. And typically most financial institutions will have a deadline. A lot of them are in November, some are in December. So reach out to your financial institution to ask them, like, I want to convert my RRSP to a RRIF this year so that I have that minimum amount next year, or my RRIF to a LIFT. When's the deadline for that? And make sure you understand what that deadline is, the paperwork that's required for that, because we're bumping up against that now. So a lot of you are planning to draw money out next year. There's a benefit to convert before the year end. So you have that minimum payment, less withholding tax, etc. We've talked about that a lot here. I won't dive into that. But if you plan to draw from income accounts next year and they are not open yet, this is your warning. You need to get on it. It might already be too late, depending where you're at. I know a lot of financial institutions, the deadline was early to mid-November. Some go into December. So don't just say, well, December 31st. They have processing, back office stuff to do. So just be very aware of that.
Yeah, I always suggest to people to do what I call your tax planning transactions late October into November, depending on what the timeline is. Don't leave it to December. December gets crazy for obvious reasons in terms of end of year end, holidays, things like that. And also know that there's really no or little downside to opening a RRIF, LIF early. In that I can open up a RRIF in June, in February, and maybe I put $50 or $100 in it because I'm worried my financial institution will close it on me if it has a zero balance for 3 months. The worst case scenario there is that I have a $100 balance come January 1st next year, and based on some percentage, based on my age, I have to take a certain amount of money out of there. At 71, that percentage is about 5%. So I have to take $5 out of my RRIF in that year, if I was 71, and add that to my taxable income. That is...
No, it does create tax slips and stuff. But yeah, definitely if you're planning on, plan ahead. Like, again, you can set up the account and then fund it more later on. It's just so many people bump up against the end of the year now. And there'll be people watching and listening to this that don't get it done in time. And it's not that you can't do it next year. It's just there's no minimum amount. They're withholding tax on from $1. It's just, keep more money back in your pocket. So
if you think you need it, just get the account open and then go from there.
Exactly. Well, Brett, that's another podcast episode 12 done. Thank you everyone for listening and watching. Again, if you have questions for us, comments, feedback, anything like that, leave it below in whatever medium you're watching or listening on, and we'll see you in the next one.
Yeah, and W. Woodcocks, if you're ever going to a Red Green convention, please let me know. I'll bring Adam.
End it at that. Yeah, exactly. Thanks, Brett. We'll see you in the next one.
Yep.
Bye. Thanks for joining us on this week's episode of Retirement Unpacked. If you found today's conversation helpful, don't forget to subscribe so you don't miss next week's episode. And remember, the ideas we talk about are general in nature. They may not fit your personal situation. Always consult a qualified financial planner before making decisions about your retirement. Take care, and we'll see you next week.